Welcome to our comprehensive guide on the price-to-sales ratio, a cornerstone metric for modern investors. While the price-to-earnings ratio often takes center stage, the PS ratio provides a unique lens into a company's valuation by focusing on the top line, its revenue. For high-growth companies that are reinvesting every dollar back into their operations, traditional earnings might be non-existent, making the PS ratio the most reliable tool in your arsenal. Today, we will explore how this metric measures the market's value for every dollar of sales generated, helping you identify opportunities that others might overlook due to temporary lack of profitability. Whether you are a seasoned portfolio manager or an aspiring entrepreneur, mastering this ratio is essential for navigating the complex landscape of high-growth investing. We will break down the calculation, the benchmarks across different industries, and the strategic advantages of using revenue-based valuation to gauge market sentiment and long-term potential. Calculating the PS ratio is straightforward, yet its implications are profound. There are two primary ways to arrive at this number. First, you can take the company's total market capitalization and divide it by its total revenue over the last 12 months. Alternatively, you can divide the current share price by the sales per share. For example, if a company has a market cap of $10 billion and generated $2 billion in revenue, its PS ratio is 5.0. This means investors are willing to pay $5 for every $1 the company earns in sales. Understanding this calculation allows you to compare companies of different sizes within the same industry on an even playing field. It strips away the complexities of accounting treatments for taxes and interest, providing a raw look at what the market believes the company's core business-generating power is worth today versus its future growth trajectory. In the world of tech startups and biotech firms, profitability is often years away. For these high-growth entities, the PE ratio is useless because earnings are negative. This is where the PS ratio shines. Revenue is much harder to manipulate than net income, as it sits at the very top of the income statement. It reflects the actual demand for a company's products or services before expenses are deducted. Investors use this to determine if a company's growth justifies its current valuation. A steady or increasing revenue stream in a pre-profit company suggests that the business model is gaining traction and scaling effectively. By focusing on sales, you gain a clearer picture of market share expansion and customer acquisition success, which are the primary drivers of value in the early stages of a company's lifecycle. It provides a baseline of reality in an environment often driven by hype. Determining what constitutes a good PS ratio is highly dependent on the industry and the growth rate. Generally, a PS ratio below 1.0 is considered undervalued in traditional sectors, suggesting that the market is paying less than $1 for every dollar of sales. Conversely, high-flying tech companies might trade at PS ratios of 10.0, 20.0, or even higher. While a high ratio suggests a premium valuation, it also reflects high expectations for future expansion. If a company has a PS of 15.0 but is growing revenue at 100% year over year, it might actually be more attractive than a company with a PS of 2.0 that has stagnant sales. The key is to look for divergence. When a company's sales are growing rapidly, but its PS ratio remains low compared to historical averages or its peers. This often signals a potential buy opportunity for value-oriented growth investors. You cannot compare the P to S ratio of a grocery store to that of a software company. Grocery stores operate on thin margins but high volume, often resulting in P to S ratios as low as 0.2 or 0.5. In contrast, software as a service, SaaS companies have high margins and recurring revenue, often commanding P to S ratios between 8.0 and 15.0. This disparity exists because a dollar of software sales is typically more valuable. It has a higher percentage of profit attached to it once the initial product is built. When performing your analysis, always benchmark a company against its direct competitors within the same sector. If a tech firm has a P to S of 12.0, while its peers are at 20.0, you need to investigate why. Is it an undervalued gem, or is there a fundamental flaw in its growth story? Contextualizing the ratio within industry norms is the only way to avoid the trap of comparing apples to oranges. The debate between PS and PE ratios often comes down to the maturity of the company. The PE ratio is the gold standard for established companies with steady, predictable earnings. However, earnings can be managed through accounting choices.
buybacks, or one-time tax credits. Sales, on the other hand, are much harder to fake. The PS ratio provides a more honest look at the business's scale. It is particularly useful during economic downturns when earnings might dip into the negative for many companies, but sales remain relatively resilient. By using both ratios together, you can identify quality growth. For instance, if a company has a low PS but a high PE, it might indicate very low profit margins. If it has a high PS but a low PE, it could mean the company is exceptionally efficient at converting sales into profit. Integrating both metrics provides a 360-degree view of financial health.
While the PS ratio is powerful, it is not without flaws. Its biggest weakness is that it ignores profitability and debt. A company can have massive sales, but be losing money on every single transaction. A low PS ratio in this case might be a value trap rather than a bargain. Furthermore, the PS ratio does not account for the capital structure of a company. A firm with a low PS but a massive amount of debt might be in a much worse position than a firm with a higher PS and a clean balance sheet. To mitigate these risks, investors should look at the enterprise value to sales, or EV sales, ratio, which incorporates debt. Always remember that sales do not equal cash in the bank. Without a path to profitability, even the most impressive revenue growth can lead to insolvency. Use the PS ratio as a starting point for your research, not the final conclusion. To wrap up, the price-to-sales ratio is an indispensable tool for evaluating high-growth companies, particularly those in their early stages. By measuring the market's valuation against total revenue, you can bypass the noise of temporary earnings fluctuations and focus on the core growth engine of the business. Remember the 3 pillars of PS analysis. First, always benchmark against industry peers. Second, look for a sustainable path to profitability. And third, use it in conjunction with other metrics like debt to equity and the PE ratio. In a market that often overreacts to quarterly earnings misses, the PS ratio can help you stay focused on the big picture. By identifying companies with strong revenue growth and reasonable valuations, you position yourself to capitalize on the leaders of tomorrow. Thank you for joining us for this deep dive into strategic valuation. Start applying these insights to your portfolio today to refine your investment strategy and achieve long-term success.